Every Monday to Friday, this is Peter Lewis's Money Talk.
Money Talk.
Good morning from me, Peter Lewis, and a warm welcome to my podcast, Money Talk, for Wednesday, the 12th of April. And this podcast is sponsored by online financial services company Surfing Group, which is headquartered in Singapore. In today's business headlines, the International Monetary Fund has trimmed its forecast for global real GDP growth to 2.8% for this year and 3% for next year. Both the 2023 and 24 forecasts were marked down by 0.1 percentage points from estimates issued in January, partly due to weaker performances in some larger economies. And that represents a sharp slowdown from the 3.4% growth seen in 2022 due to tighter monetary policy. Interest rates in major economies are expected to fall to pre-pandemic levels because of low productivity and ageing populations, according to another forecast by the IMF. It says the current increases in borrowing costs are likely to be temporary once high inflation is brought under control. Consumer prices in China were softer than expected last month, and deflation in factory gate prices matched estimates, opening the door for further stimulus from policymakers. The Consumer Price Index rose 0.7% last month from a year earlier, down from 1% in February. This was the lowest figure since September 2021 as the cost of both food and non-food eased further. And China's powerful internet regulator, the Cyberspace Administration of China, has proposed new checks on artificial intelligence chatbots to control how its tech industry rolls out generative AI models. The new proposals said providers would have to submit their products for security reviews before their public release, and it would set up a database to register them. The new rules, released just hours after Alibaba and SenseTime unveiled new ChatGPT-like bots, said content generated by artificial intelligence should embody core socialist values and must not contain any content that subverts state power, advocates the overthrow of the socialist system, incites splitting the country, or undermines national unity. On today's Money Talk, I'm joined by personal wealth advisor Enzio von Pfeil and Richard Harris, Chief Executive Officer at Port Shelter Investment Management. And with a view from Japan is John Beirne, Vice Chair of Research at the Asian Development Bank Institute. And if you want to get in touch, please go to my website, peterlewismoneytalk.substack.com.
Peter Lewis's Money Talk.
US equities were mixed Tuesday ahead of consumer price inflation data due later today that is likely to filter into the Fed's thinking on future rate hikes. The S&P 500 ended the session flat at 4,109. The Dow rose 98 points, or about 0.33%, to 33,685. Meanwhile, the Nasdaq Composite shed 0.4% to 12,032. Energy stocks led the move higher as oil prices racked up gains, even as investors continue to fret about a weaker global economy hurting energy demand. Brent crude oil settled 1.7% higher at $85.61 a barrel. Stocks in the Asia-Pacific region rose on Tuesday. In Japan, the Nikkei 225 climbed 1.1%. After the new Bank of Japan Governor, Kazuo Ueda, signalled that any significant changes to monetary policy may be unlikely for now. Shares were also boosted after Warren Buffett said that he plans to add to his holdings of Japanese stocks and is considering additional investment that would raise his stake in 5 major trading houses in Japan. Hong Kong's Hang Seng Index rose 154 points, or 0.8%, to end the day at 20,485. Futures markets are predicting the index to fall 0.4% at the open this morning. Shares of Alibaba rose as much as 3.8% at one stage before ending the day 1.6% higher after the tech giant's cloud computing subsidiary became the latest Chinese player to unveil a ChatGPT application after Baidu's ErnieBot was launched in March. Alibaba's program is called Tongqi Tianwen and will possess Chinese and English language capabilities. And one other thing to note in the markets, Bitcoin rose past $30,000 for the first time since June last year, taking its advance since the start of the year to more than 80%. Bitcoin has gained more than 7% in the past 24 hours to $30,190 according to Coinmetrics. And you can get more details on all the latest market movements on my daily blog, which is peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
Let's go straight to our guests. And as always on a Wednesday morning, we have wealth investment strategist Enzio von Pfeil with us. Morning, Enzio.
Good morning, Peter.
And also I'm pleased to welcome Richard Harris, who is Chief Executive Officer at Port Shelter Investment Management. Morning to you, Richard.
Hello, Peter and Enzio.
Morning, Richard.
Now, the IMF has been saying quite a lot overnight. First of all, it's trimmed its forecast for global real GDP growth to 2.8% this year, 3% for next year. At the beginning of its spring meeting with the World Bank, which has just kicked off in Washington, D.C., both the 2023 and 2024 forecasts were marked down by 0.1 percentage points from estimates issued in January. That's partly due to weaker performances in some larger economies. And it does represent a sharp slowdown from the 3.4% growth seen in 2022 due to tighter monetary policy. Enzio, I think it's fair to say on this show that you've been less than impressed by IMF forecasts in the past. So what do you make of this one?
Well, I'll stay consistent, Peter. I think that IMF stands for I am fired. And the problem with the IMF is not a lack of brains. It's the fact that the reports are issued by a committee, and as we all know, a horse is a camel designed by committee. So what I mean by that is that when they come in with these forecasts, we all know that things are looking bad. We all know that the US is in the doldrums. We know that China has problems. We know that the banks are having problems. So for the IMF to come out and say, for instance, that the banking problems have been contained, or that the global growth is only going to slow by a 0.01% is a nothing number. The fact is that the Baltic Dry Freight Index is 75% down from its peak in September 2021. That's more than a 0.1% shave on the growth forecast. So it's lacking in originality, it's lacking in foresight, partly because, as the Economist said, it's lost sight of its mission, which was really to backstop countries in distress, instead going for other things now that are woolly and I'm sure very commendable, but not really sticking to the knitting anymore.
What sort of things?
Well, I think I think commendable is gender equality, totally commendable, no problems with that. But the fact is that the banks aren't, the third world, the developing countries are having a lot of problems getting lending, getting financing, and that's going to then just make global growth much stickier. Again, climate change, totally commendable, absolutely vital, especially what we're seeing with the Arctic and all that mess up there. But again, it detracts from the core mission of the IMF, which is to lend to countries that need money, and they're not lending because it's getting stuck in mission red tape.
Well, I can only agree, Enzio. I think one of the problems is that the IMF tends to go around all the member countries and territories with a clipboard asking them what their growth is. And naturally, it's going to be affected politically in that sense by authorities all around the world looking to give the figure that they want. The figures in recent years have been dominated, obviously, by the US and China, the two biggest markets. So they tend to be very backward looking. And it's very much like the economist joke of, economists look at the economy by looking in the rearview mirror, by driving by looking in the rearview mirror. And that doesn't really work. But there is one piece of important information, I think, to come out of the report, which is where they warn of a hard landing for the global economy if inflation persists. Now, that's been worded very carefully. But I think when we're looking at this, we have to look at the word if inflation persists. There seems to be absolutely no evidence that inflation is slowing down. There's almost no evidence that interest rates are going to turn tail. Right. And the IMF's, if you like, the looking forward element there, I think is probably quite accurate.
They say on inflation, they're basically saying the current increases in borrowing costs are likely to be temporary once high inflation is brought under control. So they are being a bit bold there. But doesn't this all sort of sound a little bit like Jerome Powell saying inflation was transitory a couple of years ago and turning out to be very wrong?
Well, isn't everyone talking their own book? You know, you had Janet Yellen, the Treasury Secretary of the US, coming out the other day saying very much the same thing. You know, don't worry, things are quite tough at the moment, but they're slowing down. Things are slowing down. And if you look at the figures, that's indeed true. But if you're looking at inflation around 5% in the US, and just use that as an example, compared to inflation being next to nothing 2 to 3 years ago, certainly pre-COVID, there's a very big difference there. So yes, we may be getting a bit of a slowdown, but it's after a very rapid surge.
The one forecast that did stand out a little bit from the IMF was that it forecasts global growth at 3% in 2028, in 5 years' time. Yeah. That's its lowest 5-year growth outlook since the World Economic Report was first published back in 1990. And it pins that on some emerging economies becoming more mature, also slower growth in workforce populations. But I'm wondering, is it even possible to make a forecast for 5 years out when, you know, people have been so horribly wrong in just 1 year, when, you know, things crop up like the war in Ukraine, the banking crisis, that people just can't possibly predict? So does this sort of forecast have any meaning?
Well, I agree with your rhetorical question that I think that it's totally academic. It's quite pointless, frankly, to be doing these forecasts, because we're all going to by tomorrow we will have forgotten what they're forecasting in 5 years' time, and who really cares? The issue is the task at hand, as Dale Carnegie would say, and the task at hand is to try and get things moving. What they're not really addressing yet again is the whole structural issues that we are confronted with, terrible middle-class education in America and things of that nature.
I think, sorry, if you're looking at economies, they do tend to be quite robust over the very long term. But the problem is it's very difficult for us to look in the very long term. It's one thing to look at a very long-term chart and just extend the line, which the IMF is doing. But it's very different when you're actually at the coalface trying to make some money in a company, trying to make some money in a job, etc., and indicators are moving all over the place. So you're quite right, Peter, that people look at the short term. The IMF looking at the long term is merely academic.
I suppose the big question, though, that we're all wondering is the recent events in the banking system. Is this signalling maybe that there's going to be more systemic stress, and that maybe the global financial system is going to be tested further going forward? Because the policymakers are sort of rather talking it down at the moment, aren't they? They're talking as if it's all under control. It was a little blip, but they've got on top of it. Do you agree with that assessment? Or do you think, as we saw in the global financial crisis, when these things tend to get spread out, don't they? You had Bear Stearns, then you had Countrywide in the UK. Something else just keeps on popping up. Do you think we're going to see the same thing again?
Well, I certainly think so. I think that the FT ran a very, very trenchant article in yesterday's issue about how the medium-sized banks are having more and more problems because their deposits. There's been a lot of deposit run in these medium-sized banks, as we all know, and then the loan book is beginning to shrivel a little bit because of the worsening credit crunch, which is exacerbating the Fed's quantitative tightening, which, by the way, is only about a year old. So I think that these medium-sized banks are going to be facing huge problems, and you can't just throw money at it and hope that it will go away. If nothing else, it will lead to a massive concentration of banking industry. Only the few big ones really rule the roost. And that, of course, then means that the consumer gets the short end of the stick in America yet again.
Too big to fail. One thing that was mentioned actually by, I think, the IMF in looking at the banks is they're talking about the weakest link. And in fact, what we saw with Silicon Valley Bank go down, we saw the weakest link go down, associated, I might add, by some rather loose talk from many of the depositors. In fact, Silicon Valley Bank had not that many numbers of depositors, and I think one of the depositors pulled 140 million out almost instantly. So, no bank could really handle that. But then the spotlight turned to the next weakest link, which was Credit Suisse. And I think that the banking sector is going to continue to have analysts poring over it, looking to see if there's a weak link here and there. However, I do think the authorities know this, and I do think the authorities will come in to try and cut these kind of bank runs off of the source.
It's hard to know, isn't it, the state of banks? Because if you look at their filings, their audited reports, and they're just a complete black hole. Even sort of seasoned investors with a lot of experience struggle to understand what's going on in a bank. So isn't there always the risk that there's something going to pop up somewhere that we just didn't expect to know about?
Well, a lot of commentators talk about, the concerns with fractional banking. Basically, a bank takes in 100% of deposits and it lends out, let's say for the sake of argument, 80% of those. So if suddenly everybody comes to town and wants their money back, a bank can't really deal with it. But that's the system we have, and that's a system that's produced enormous wealth for the world in the last 400-500 years. And that's just how banks are. And that's why banks are special and why authorities have to come in to bail them out if they get into trouble.
So is the banking system stronger than it was in 2008 now?
No. I think that, if I can cut in, I think that a lot of the reason for this murkiness in the medium and smaller banks is because President Trump decided to revoke a lot of the Dodd-Frank Act and make only the biggest banks really strongly regulated, and he raised the ceiling basically so that the small banks can get away with a lot more things than the big banks. The big banks are probably overregulated by now, and the small banks are underregulated, and that's, I think, where a lot of that's this dark hole in the funding gap where the small banks now have lost they have 260 billion more in loans than in deposits. That's not good, because if there's another bank run, as Richard and I suspect, Peter, agree, that on deposit run, then these banks are really going to be up against the wall yet again.
Well, the US is kind of an interesting place in banking-wise because it still has a plethora, I think 4,000 odd small or smallish regional banks. I mean, they're quite big for many other countries. Most other economies, there are one or two major banks within the economy. They've already consolidated. So if you look at Switzerland, they had two banks. They used to have four. They're now basically down to one. That, of course, in a way increases systemic risk. On the other hand, it is easier for regulators to keep an eye on them and to make sure they're managed really on the retail side more as utilities rather than risk-taking institutions.
Until we get into the whole shadow banking system, of course, because then you get a lot of this stuff being squeezed into other areas, and that's sort of what that's what the mob was made about under Kennedy and all that with the shadow lending.
Well, the amusing thing, of course, is that with all of these banks, the people that have squealed loudest have been the richest. So if you look at Silicon Valley Bank, which was banked by billionaires, they were the first one to squeal for government intervention, when the bank went down. I mean, basically, you have to put your big boy trousers on and sort of say, if you are going to take risks in these sort of areas, then you're just going to have to take it on the nose. That's why you're a billionaire.
I agree.
Could I turn our attention towards China? Now, in these IMF forecasts, Olivier Gournichas, who is the IMF's chief economist, he's projecting supercharged growth in China, while other countries revert to a more normal rate. The forecast for China is 5.2% this year from the IMF. That's really in line with Beijing's target, although the IMF does expect growth to slow to 4.5% in 2024. So, Enzio, supercharged growth in China, are you seeing that?
No, not at all. I first of all, on the international side, again, reciting that Baltic Dry Index, which we know is only one aspect of the story, but it's a telling aspect. that index is down 75% from its peak in September of 2021. On the domestic side, if domestic demand were truly so strong, then I wonder why Beijing quite sensibly is actually pushing domestic demand and saying we have to really get consumers out there shopping and all this kind of stuff. When consumption now actually only accounts for about 33% of GDP. In normal economies, it's about 70 to 80%. Thirdly, we've got bad sort of flimsy economic time. There may be some excess supply of money, but we know that President Xi is cracking down on the banking sector. The fiscal side, we know that the local finances are looking appalling, so you can't expect too many more roads and bridges to be built. And so all that we're left with is SOE, state-owned enterprise developers, who are expected to play a bigger role, but that means building more and more houses. Well, how many houses can people still buy? So I think that, again, this sounds to me like the camel was put in front of the horse. In other words, let's talk up a good story with a bit of a finger crossed.
Yeah, I think the thing in China is that 4% isn't supercharged growth, and what it's reflecting. And if you look at official figures coming down from 6% over the last sort of X number of years, we're now looking maybe at 4%. We are looking at China moving into the stage that every economy has gone through, which is it has great growth and then it starts slowing down, probably to a trend growth of anywhere between 1% and 3%.
Yes.
And I think that's just a normal passage of what happens. You know, no economy is special or different, except when it's developing. And I think China has reached a stage where it's difficult to call it a developing market. It's very much a developed country in many, many aspects. And I think that we have to expect that growth, unless you have massive stimulus from the government, which I doubt because that tends to be followed by massive recession, I think we're going to see China return more to global trend rather than strike out on its own.
Just to add to that very briefly, of course, there's also the fact that the Chinese economy is now so much bigger than it used to be. It's what we obviously, as we all know, call the base effect. So it's tougher to grow by 10% if the base is much higher than it was 10 years ago. So that's also worth just keeping in mind.
If we were going to see supercharged growth, presumably you would see also inflation picking up in China, but that's not happening, is it? It's actually going the other way. The data yesterday showed the consumer price index rose 0.7% last month. That's down from 1% in February, the lowest figure since 2021. And producer price deflation is accelerating. Producer prices dropped 2.5% in March. This isn't consistent with strong growth, is it?
I think the thing with that is that China is on a different cycle from the rest of the world. It came out of COVID much later. Therefore, you are going to see greater growth as it comes out. And I think we've all been surprised that we haven't seen the explosive growth we saw in the West. It's been more muted. But I think there's no doubt that people will go back to traveling, they will go back to spending, all the things they couldn't do during COVID. So China is on a different cycle, and it's also more of an industrialized country. So as commodity prices ease from the COVID period, then that's going to flow through to the economy. So I see it being, dare I say, the reduction in inflation being transitory, as opposed to something that's is really appearing to be a real trend.
Yeah, looking at my economic talk, I agree that the Chinese economy is still, in a manner of speaking, the economic time is characterized by an excess supply of money and an excess demand for goods. In other words, there's still a bit of demand around, even if that inflation, the demand side of inflation is moving down. Whilst in America, as Richard was pointing out, the cycle is quite the opposite. There's an excess demand for money, what with the Fed having tightened some time ago, an excess supply of goods looming.
And
I think the interesting... Sorry, Peter.
No, you carry on, Richard.
I was just going to say, I think one of the more interesting metrics to look at in the next maybe the next 6 months or so, is going to be economic growth and corporate profits, because inflation looks as if it's going to continue on trend, interest rates continue on trend, i.e. go up, Unemployment is, employment is pretty steady. The big question is, are companies going to make less money? If they do that, will they start laying people off? And that is going to be the real sign that we may see the end of an interest rate inflation cycle. But that's not happening yet, and there's no evidence that it's going to happen in the near term.
I think there's a bit of a slow motion recession coming in with my very hackneyed forecast years ago already of a form of stagflation, a higher inflation, as Richard was saying, 3 to 4%, maybe even 5%, and slower growth coming through. We see it already with the firings in the financial sector and the tech sector, so I would respectfully differ a little bit there. But no, it hasn't hit big time yet. I think the more that quantitative tightening hits, the more the credit crunch hits, the more we will see the worsening in the labour markets.
Okay, well, thank you very much for your thoughts there. Great discussion. You heard there our regular Wednesday morning guest, Enzio von Pfeil, wealth investment strategist, and also Richard Harris, who is Chief Executive Officer at Port Shelter Investment Management.
Peter Lewis's Money Talk.
I'm joined now by John Beirne, who is Vice Chair of Research at the Asian Development Bank Institute. Good morning, John.
Good morning, Peter. How are you?
I'm very well, thank you. Now, yesterday, new Bank of Japan Governor Kazuo Ueda has taken over the reins from Haruhiko Kuroda, held his press conference. And he rather gave the impression that negative interest rates and yield curve control and all that are going to be appropriate for the current economy, at least in the near term. So what do you make of that, John?
Yes, I think the transition to the new governor has been very smooth. And this is helped, of course, by the fact that we don't expect any change in monetary policy or the underlying monetary policy framework, at least at the current juncture. I think that communication at the press conference was very clear. There will be close monitoring, of course, on inflation developments during the course of the year and the factors that will be driving that both on the external side and domestically, particularly the impact on coming from the wage side.
Is it sustainable, though? I mean, the market is expecting at some point, or maybe at some point soon, for there to be some change, because inflation is picking up, isn't it, in Japan? And also, you've got this huge differential now in rates between Japan and the rest of the world. That's
right. I mean, I think it's well understood that inflation is amplified in Japan, particularly given its historical level. It has come down somewhat, I think, to around 3.4, 3.5%. And that's even excluding the volatile items. So that's looking at core inflation. I think that one thing to bear in mind is that once these base effects fall out of the calculation, we should be looking at an inflation level more in line with the target. And that is something that may materialize maybe not this year, but certainly during the course of 2024. So this really underlies the decision to maintain the current monetary policy at its prevailing level. But of course, things may change, and particularly from the external side, there could be factors which could affect inflation. As you know, as I'm sure you're aware, wage negotiations are being closely watched in Japan. The large unions agreed on 3.7% rise, which is historically very high. And this, of course, would be, higher than the inflation target. So it remains to be seen whether this would spill into economic activity and the type of inflation that is desired, which is demand-driven inflation.
And if you look at the last Tankan report, those wage increases and other things seem to be feeding into inflation forecasts going forward, don't they? Because businesses are now forecasting inflation for the coming year at 2.8%, which is above what the Bank of Japan is forecasting. So it does seem to be filtering through, doesn't it? In sort of certainly expectations.
Yes, I mean, there's a little bit of uncertainty, I would say, in this regard. We saw recently large sales of bonds by Japanese firms, and this would point to some concerns about future tightening going forward. And this is sort of like a hangover, if you like, from what we saw taking place with SVB in the US, which of course was very much affected by tightening US monetary policy and its holdings of treasuries. In the Japanese case, there are large holdings not only of US treasuries, but also Japanese bonds. And, a tightening in policy would have implications for that, although not at the scale of what we saw in the US, because there's, of course, a much more diversified set of depositors in the Japanese case.
So do you think there's possibly an SVB hiding out there somewhere in the Japanese banking system?
I think the Japanese banking system is largely much more resilient in terms of the level of underlying capital and liquidity buffers that it holds. Also, as I said, the nature of the depositor base is much more diversified. And, when you have this type of diversification, it obviously is a buffer in itself against external shocks, and it's good for resilience in this regard.
I suppose coming back to Mr. Ueda, one of the things I'd like to hear from him, which he hasn't spelt out yet, and maybe it's a difficult thing for him to spell out, and we've seen the Bank of Japan grow its balance sheet now to about $5 trillion US. We've had 23 years of quantitative easing. How on earth does he get out of that? How on earth does he somehow manage to wind that down without causing chaos in the financial system and the markets?
Yes, it's a very good question. I think that, firstly, communication to markets is vital, and this would alleviate any, financial stability, negative financial stability implications that would come from that. But of course, in order to warrant a shift in monetary policy, it's necessary to, observe the type of sustainable inflation that the target is aiming towards. And at the moment, it's unclear, certainly for 2023, whether this will be something that is achievable. As I said, when the base effects fall out of the calculation, we are likely to observe inflation rates much lower than what we see at the moment, at over 3%. So I think that communicating this to markets, and also understanding that, what we're really talking about here is achieving sustained inflation, but which is demand driven, and because of course monetary policy is a demand management tool. So this will be an important factor in any shift in monetary policy going forward.
And presumably that any shift in monetary policy does have global implications, doesn't it? And global risks as well, not least because Japanese pension funds and banks own huge amounts of US Treasury bonds. I think they're the largest holders in the world now, aren't they? Now that China has sold some of its off. So presumably we've got to look out for what the global risks of this could be.
Yeah, absolutely. That's an excellent point. And I think, fiscal sustainability is something that we haven't really been talking about in Japan for many years, because, of course, monetary policy remains at very low levels, or even negative interest rates. But, of course, as in a scenario, let's say, where monetary policy would tighten by, let's say, 100 basis points, this would have severe implications potentially for fiscal sustainability. And, the IMF released its Article 4, I think, on April 6th last week for Japan, and noting that, fiscal consolidation is crucial going forward over the medium term. And I'm sure that this factor of potential tightening in monetary policy was a key consideration. That would be one of the concerns. Any tightening would need to be done in a smooth way, and also bearing in mind the implications for fiscal sustainability, given the issues that you mentioned. And
in the IMF's global growth forecast, which it released overnight, on Japan, it's revised down its forecast now. It expects growth to be 1.3% this year. It was forecasting back in January 1.8%. That's quite a sharp revision downwards, isn't it? Is that something that you concur with?
Yes, I think the downward revision is closely related to what we have observed in the global economy. So, there are pressures as a result of that for the Japanese economy on the external side. On the domestic side for Japan, accommodative monetary policy will still be important for driving consumption, business investment. Exchange rate volatility is now much lower than it was during the course of 2022. So this also helps business investment. But on the external side, there are still concerns. The US economy is still sort of in a tightening phase in its monetary policy. Inflation seems to be a little bit sticky in the US, and this is having implications for not only Japan, but obviously the rest of the global economy as well.
Finally, on a totally different topic, but something that is very topical out here at the moment, ChatGPT. We've seen Alibaba and SenseTime here launch their ChatGPT-like bots. Lots of talk in the US and China about how to regulate these types of applications. What's happening in Japan? Is this something that is grabbing attention over there as well? And are you seeing equivalent Japanese versions of ChatGPT bots?
Yes, well, this has been in the news recently about ChatGPT, and there are talks of an expansion to Japan. I think one must be concerned about this. Of course, it's important for potential impacts on productivity and competitiveness, which are very important, particularly in the case of Japan. But there are concerns that could be implications for inequality, and there are the usual drawbacks with these types of innovations in terms of the uncertainty that they have certainly at the initial stages. So I think anything that can be used to boost productivity, but in a manner which does not contravene inequality or can do so in a sustainable way is something to be welcome. But again, I would exercise some caution in opening that across the board. For example, in universities, there are some concerns that it could affect the fairness with which research is undertaken and things like this.
John, thank you very much indeed.
Thank you.
That's John Beirne, who is Vice Chair of Research at the Asian Development Bank Institute. And thank you to my guests this morning, and thank you for listening. Tomorrow we'll have the latest business and finance news as Asian markets open. And joining me to discuss those headlines will be Lashar, Asia Chief Economist at BBVA, and Dickie Wong, who's Head of Research at Kingston Securities. And with a view from Taiwan is Ross Feingold, Business Development Director at SafePro Group. See you tomorrow.
Money Talk.